Hello, very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Thursday, the 15th of August 2024. So before we jump straight into our Daily Dose of Market Insights for today, as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. Excuse me. Okay, good. So before we jump straight into today's short-term intraday technical outlook on the major cross-asset classes, as usual, let's have a recap what has taken shape yesterday in terms of the news flow, economic data release, and their impact on the major cross-asset classes performance on a very short-term basis. Then secondly, we will actually focus more on a fundamental and intermarket dynamics. That's for more of a longer-term horizon, multi-week horizon, or I'll put it away that medium-term horizon. And lastly, we will sum up with the intraday technical outlook for today on the major cross-asset classes. So let's focus on what has taken shape yesterday. So yesterday, in terms of economic data release, we do have this very all-important US CPI data that came in more or less within what is markets expecting. So it's a continuation of a so-called trend deceleration in the core inflation rate that is excluding energy and food prices at 3.2%. So that is the lowest level since around 3 years, okay, around 3 years. So 3.2%, markets were expecting at 3.2%, and that's 1 basis point lower than 3.3% that was being so-called recorded in the previous month of June. So a quick recap on the trend of this US CPI data over here. So very clear trend of deceleration. So you look at the 5-year trend is clearly decelerating from its current we call it so-called major peak that was peaked in 6.6% in September 2022, and the current rate of 3.2% is the lowest level since April 2021. So that's a 3-year low. So that I would say that this what we call it encouraging deceleration trend in US inflation rate is supporting the Fed to kickstart a interest rate cut in September. But what's interesting over here that the markets right now has starts to toggle. The last few weeks it started to toggle between either 50 basis point cut or a 25 basis point cut because due to the risk of a hard landing, and this expectation will change as more economic data comes to play, especially after today's release of the US retail sales figure, because US retail sales figure is we got related to what I call consumer spending or consumer sentiment. So later I'll talk more about that. So what we could see over here is that if you look at the aggregate probability, current Fed fund rate is at 5.25% to 5%. So now the Fed funds futures market, based on the data compiled by this CME Fed Watch 2, is looking at very high odds of 64% of a 25 basis point cut on the September meeting. That means 18th of September FOMC meeting. So the 50 basis point cut previously, when we shared a goal about close to about 50% or 49 plus, has now dropped to only 36%. All right. So market participants, after yesterday release of that CPI data, but perhaps the CPI data did decelerate much below expectation. That means, i.e., there is no risk of a US slipping into what I call a deflationary trend mode yet. That means it reduced the odds of a hard landing scenario in US. So that actually explained the reduction in the 50 basis point probability based on the Fed funds futures pricing yesterday. All right, so this is the latest data that we have. All right, so but what's interesting over here is that the 50, because if we are talking about if the market were to came in within expectation at what based on the current pricing of the Fed funds futures market, the Fed cut 25 basis point on 18th of September, which bring it down to 5% to 5.25%. Then what market is expecting is the next cut will be a 50 basis point cut to bring it down to 4.5%. All right, there's a high odds of 63% on the November meeting. So that actually comes right after the US presidential election. Okay, so only 37% chance of another 25 basis point cut. So the pricing is not rather constant in terms of the expectation right now. Okay, so what we could see, but for sure, is that high chance the Fed will kickstart its interest rate cut cycle starting from 18th of September, because the data has really supported it to do so, more and more data. So how does it impact the US benchmark stock indices yesterday? So what's interesting over here is that I would say that is rather lukewarm, not really that fantastic. Why? Because the high beta market leader, Nasdaq 100, almost closed unchanged at 0.09%. All right, the S&P managed to inch out again at 0.38%. The Dow Jones yesterday outperformed 0.61%. But however, the Russell 2000, which is considered of small cap company that highly dependent on their revenue from the US economy, underperformed with a negative 0.52%. So it's not really a kind of a very rosy, all out bullish story yesterday, or bullish picture, I would say, on the US stock market. Perhaps the market has really more or less priced in this expectation of this ongoing, of this continuation of a deceleration trend in US inflation, and also very likelihood ahead of today's another key data event, which is a risk event, I would say, is the US retail sales, because the US retail sales more or less will have a gauge on whether the US economy situation, whether we're talking about the fear of a hard landing or recession scenario, will start to creep back into the market again if US retail spending turn out to be very weak or coming below expectation. Later we'll talk more about that, okay, when we cover the economic calendar. So, and if you look at the story of the FX market, so over here the FX market, what I could see over here is it starts to go sideways again yesterday. All right, it started to turn sideways, and what we could see over here is that the dollar actually continues to underperform against the sterling and the euro, against the euro currency, but the dollar is strongly outperforming against the kiwi. Why? Because of the central bank of New Zealand cut interest rate, and they actually starts to eradicate their earlier hawkish bias. Right, so that actually explain to us the continual weakness of the kiwi against the dollar, or the dollar is right now continue to strengthen against the kiwi over here. Then what we could see over here is that later the dollar is still holding pretty much firm against the yen and against the Swiss franc. So later I'll touch more about the dollar yen, but the dollar yen seems to be right now, in terms of a technical analysis perspective, is still going nowhere, because it can't break above the 14850 key short-term resistance level. Okay, later I'll highlight more about doing the short-term technical outlook. Yes, but what's interesting over here is that if you were to look at the dollar index over here, let's go to the technical chart, the performance of the dollar index. Okay, so if you could see over here is that this dollar index yesterday, after the release of the US CPI data, it continues to plummet, right? But how it ended, right? It ended off with a bullish reversal candlestick, or we call it a key reversal day. Japanese candlestick, it called bullish reversal. It's a bullish reversal Japanese candlestick. And the formation of this bullish candlestick, if you put into momentum perspective, this is the daily RSI. The daily RSI managed to shape a higher low. All right. So indicating to us that the downside momentum has started to ease off over here. Okay, means the downside momentum from the high of 30th of July has started to ease off, and it reflected this bullish reversal daily candlestick, and this daily bullish reversal candlestick formed right at a support level at 102.20, and this 102.20 is in fact also correspond to the symmetrical triangle range support level. Is in place since 18th of July 2023. All right, which is also quite a key medium-term support level, or say put it with a major range support level that is start to form. All right, over here. Okay, so what it means, given that the push down of the dollar index yesterday, but it managed to form a key reversal day coupled with a bullish divergence on the daily RSI. And these two positive technical element is being formed right at a higher level support level that's been derived on the daily time frame chart, 102.20, which is this symmetrical triangle range support level that is in place since the low of 17th of July 2023. Right, so that's a pretty much almost a year back then. So given this formation of a key positive element right at a longer term support level, which is precedent of a shorter term support level, that means i.e. there could be a chance that the dollar index right now could shape a mean reversion rebound back into this area here again. That means back into at least back into this last higher low at 103.55 slash 104, corresponding to the 20-day and the 200-day moving average acting as a resistance level. All right, so that means i.e. in short term there could be some form of dollar strength coming back into the picture for some of the pairs. All right, for some of it, for not all pairs, for some of the pairs. Why? Because this is a dollar index, or it's like a something like a benchmark inside. So some pair may actually doesn't really move in line with the dollar index, and the dollar index is heavily weighted by the euro dollar. Right, the euro dollar has a strong weightage on it. Okay, so yes, I agree that the euro dollar will move hand in hand with the dollar index. That means, i.e., if we start to see the dollar bouncing, index bouncing, that means potentially the higher chances for the euro dollar to actually shape that setback. Okay, the setback narrative. Okay, so that's for the things that take shape yesterday, and in terms of the cross asset classes performance. And one more thing to highlight is that earlier this morning there was a release of this key China data, which is the housing data, which is continues to be rather lackluster. So the housing price index in China going to plummet way below what was printed in June. So in June, negative 4.5%. Now it goes down much lower at negative 4.9%. So if you look at the trend, okay, of the housing price in China, okay, going to plummet. So if you go to the max, okay, right now it almost coming close to July 2015 level. Okay, so right now the current level is 4.9. Okay, 4.9 over here. Okay, 3.78. Okay, so almost going down to the low of July 2015. Okay, so what we could see over here is a very clear no signs of any signs of bottoming in the housing market for China. That means, i.e., we know that the China economy in the last 20 to 30 years, majority of the the household wealth is being kind of indirectly or directly tied to the faith of the housing market in China. And given the continual plunge of the housing prices in China, it will highly likely lead to a negative feedback loop in terms of consumer sentiment. That means with a weak housing prices, no signs of bottoming, potentially lead to weak consumer sentiment, and potentially lead to lackluster internal demand in China. That means, i.e., the deflation risk spiral will still be pretty much intact unless the Chinese government starts to reallocate more resources to shore up this area of the economy to boost up the internal demand. But unfortunately, the China top policymaker highly emphasize on high-tech industrialization policy right now. That means we're talking about focusing on their external economy to grow China, we call it status in the world, and growth via exports in high industrialization product like EV, electronic vehicle, biotech products or bioscience products, as well as semiconductor and its related components. All right, so that's explain the ongoing reason why there is no turnaround in the housing market prices right now. And if you look at the other economic data over here from China, is that the unemployment rate also starts to tick up slightly. All right, market expecting 5.1%, but it tick up higher, 5.2%, and 0.2 percent point higher than the previous month of 5% that was recorded in June. Okay, retail sales managed to inch up slightly higher, 2.7%. Okay, from 2%. Later I'll show the trend of the retail sales. It's still not really showing that much strength, given that even though it's just managed to do a slight pick up of 2.7% from 2% that was printed in July. But industrial production starts to fall slightly. Okay, market is expecting 5.2%, it fall lower 5.1% and below 5.3%. All right, so overall I would say that still not a rather stellar stock market, a stellar we call it economic data out from China, indicating any chance of a so-called clear signs of internal demand recovery. Okay, so this is what my take on this set of data over here. All right, so now let us focus more on the fundamental and the intermarket dynamics right on the China market as well, since we are on the China data point of view. So let me share with you, this is the data from China. Okay, so what I could see over here is that at the top of my chart or on your screen is the China core consumer inflation. So I will strip out the excluding food and energy prices. So this is the later one in July. So it was reported earlier, we call it this week over here. So what you could see is that the consumer inflation, yes, it managed to tick up, shape a higher low. But if you strip up food and energy prices, which is very volatile, the consumer inflation trend continues to actually plummet. So this is yes, it's actually in line with global core consumer inflation trend, but doesn't bode well for the Chinese economy. Why? Because the Chinese economy right now is facing a risk of a slow internal demand over here because of the current policy being advocated by the Chinese top policy maker. That means, i.e., neglecting consumer sentiment or consumer spending, but heavily focus their resources on high-tech industrialization to compete against the rest of the world. That means, i.e., they want to flood their EV and their semiconductor related product plus biosciences to become the major key exporter that the whole world need to rely on them. So they are focusing heavily on this set of the economic strategy rather than boosting internal consumer demand or internal demand, we call it, or consumer sentiment. So that actually explains why the consumer core inflation price keep coming downwards, all right, because of the lack of spending, retail spending in China. And what we could see over here, this retail sales. Okay, so the retail sales, even though it inch up higher to 2.7% year on year from 2% earlier on in June. This is a July figure, but it still continues to be in a very lackluster growth territory. All right, continue to inch lower high since October last year. That means it's going to inch, gradually downwards. That means there's no signs of a clear uptick at this point in time. So net overall, what we could see in this juncture here is that there is also, because of this kind of very weak indication that internal demand is not picking up steam. That means, i.e., for China, we call it traders or China investors, they also still lack the confidence to actually invest in risk assets like stocks or the equity market. And this could be depicted by this chart over here. Let me share with you. Where's the chart? Let me share. Yeah, this is the chart. Okay. Okay, this is the chart. So this is the 10-year sovereign bond yield. All right. So this 10-year sovereign bond yield continues to plummet to record lower. Notice it's one clear line down, plummeting down. So despite government, the top PBOC efforts to actually negate this plunge in the 10-year bond yield. So why this 10-year bond yield keep coming up? Because there's high demand for 10-year China sovereign bond due to a lack That means you talk about substitute. So that think about it in a way that, let's say I have surplus cash in China. As an investor in China right now, I have surplus cash. Two choice I could invest: either the stock market, which is so very cheap, valuation low compared to the rest of the world, or I invest in fixed income asset classes. Give me at least, I could potentially get back my capital back. All right. The safest one is government related bonds, and it's the longer term one, the 10-year, because they give the 10-year bond. So if there's a huge demand of this 10-year bond, it will continue to push down the 10-year yield. Okay, so bond price and yield is always inversely related. So this continuation, a push down in the 10-year China sovereign bond yield, indicate to us that China investors or traders are getting very, very risk averse instead, rather than doing risk taking of the economy. So you also explain to us the lack of confidence of a pickup in internal demand in China. Also translate to the lack of a clear recovery in China that could kind of eradicate the deflationary risk spiral. Okay, at this point in time, at this juncture. So it also represent to us that, yes, we know that the China stock market is valuation is very low, but in order to see the start of a major bottoming formation in the China stock market, I do not see it at this juncture given the current intermarket dynamics. So that also could also be translate potentially to the Hang Seng index as well, or the Hang Seng indices, because the Hang Seng index is similar like a proxy to the China stock market indirectly. All right. So one thing that is actually a bit of encouraging sign is the dollar strength. Because of the dollar strength is weak in the last month or so. Okay, let me put it on the daily chart time frame. Due to the US so-called treasury, the 2-year treasury bond premium, the 2-year treasury yield premium is getting narrower and narrower as compared to the 2-year China sovereign bond yield. That means the yield spread between the US treasury 2-year note and 2-year China sovereign bond is getting lesser. All right, so that also explained to us that particular so-called sell-off in the last 3 weeks or so as being seen on the dollar against the CNH. All right, against the CNH. So at least we know that the Chinese yuan is not weakening that much as compared to as in the past. All right, since the start of the year over here, it's not weakening that much right now. Reduce the risk of what I call further capital outflow. All right, but on the other hand, we start to see a lack of policy by top China policymakers to kickstart a positive animal spirit to jumpstart consumer confidence at this juncture, because right now their policy is heavily focused on industrialization, high-tech industrialization. So that also doesn't gel well or supports a potential bottoming of China-related risk assets. That means, i.e., the stock market. Okay, so that covers the kind of a fundamental and more medium-term interdynamics that I share with you all today, more pertaining to the China economy, the China stock market, and indirectly the Hang Seng indices. Okay, good. So now let me expand my screen over here. Okay, so that you guys could actually focus on the key levels much better. And now I will shift our focus now to the short-term intraday technical outlook. All right, so the short-term intraday technical outlook, let us start with the euro dollar first. Okay, the euro dollar. So the euro dollar, if you can still recall, yesterday we still do have a bullish bias, so it's already hit the resistance level 1.025, then maximum 1.060, 1.080 level, really hit this level already. And what we could see over here at this juncture, there was a bearish reaction. I mean, the inverted V shape hitting right at this turquoise green line here. So what is turquoise green line? If you go back in time, is actually the upper limit of this minor ascending channel that I drew from the low of 26th of June 2024. And upon hitting this line here, this so-called channel resistance, your hourly RSI starts to form a similar low. similar high, pardon me, almost a similar high. So also indicating to us some form of upside momentum has starts to ease off as well. Okay, and since that is at the top of this channel already, there could be a chance of a potential intraday mean reversion dip down back towards the next support level over here. So I'll be using 1.060 slash 1.1080, it means 11060, 11080 as my short-term pivotal resistance for today. Flip to a intraday bearish bias for this potential mean reversion drop or dip to take shape for the euro dollar. First support level to watch on the intraday basis, 1.099, followed by 1.096, 1.0950. All right, over here. So this 1.0960, 1.0950 also correspond to this dotted gray line. So what's this dotted gray line? If you go to the daily chart over here, so this dotted gray line is the former major symmetrical triangle range resistance from the high of 17th of July, now turns into a pullback support level. Okay, go back to the hourly chart again. Okay, over this point in time. Okay, only a hourly close below 1.0950, that means suddenly the price punches below 0.950, then this minor, so-called potential minor reversion drop may extend to retest the 20-day moving average, acting as a similar support, graphical support at 1.0895. Okay, only a price push up with an hourly close above 110.80 will invalidate today's intraday bearish bias to see the continuation of its uptrend, exposing the next near-term resistance at 110.11, 111.70. So what's this level? If you go to the daily time frame, is in fact this swing high here, the minor swing high, the medium-term swing high area of 28th of December last year, this part here, and 111.1770, the 111.70 is the 1.618 Fibo extension level taken from the low of 7th of April, project it to the 4th of June, push it down to the low of 26th of June 2024. Okay, this level here. All right, so that sum up the euro dollar short-term intraday technical outlook for today. So now let us focus on the sterling dollar. So the sterling dollar, what I could see is that yesterday it tries to trade sideways. So yesterday we do have a bullish bias, looking for it to a test on the first resistance at 1.2890. But if you look at the current situation right now, after the end of yesterday's US session, the hourly RSI doesn't look that fantastic to us. Why? Because there is a bearish breakdown below this parallel ascending trend line support level, now turns into a pullback resistance. So there was a bearish breakdown for it, indicating the lack of upside momentum to potentially shape higher high going forward at this juncture. So with this negative condition that is being depicted right now on the hourly RSI on the sterling dollar. So with that, we will be flipping to a bearish bias for today on the sterling dollars, very similar to the euro dollar, to shape that at least in short term on the intraday basis, a minor mean reversion drop or decline, using 1.2890 as my key short-term pivotal resistance level. First support level to watch in the near term on the intraday basis will be this two level, 1.2780, corresponding to the 50-day moving average. A breakdown below it exposes 1.2730 for today. Only an hourly close back above 1.2890 will invalidate today's intraday bearish bias to potentially see the continuation of this minor uptrend phase to continue, to target the next near-term resistance level at 1.2940, followed by 1.2990 next on the sterling dollar. All right, so now let us now focus on the Asia Pacific major pair, starting with the Australia dollar first, the Aussie dollar. So recall that Aussie dollar yesterday we do have a bearish bias hitting the support level right exactly at 65.65. Right, so bearish bias has really been met. The condition, why? Because it shaped that bullish reversal candlestick right exactly at our mentioned support level yesterday at 65.65. So using this 65.65 level, given that this positive element that is being played out on the Aussie dollar, we will now flip back to a bullish bias on an intraday basis using 65.65 as my so-called make or break level on the Aussie dollar. Next near-term resistance to watch for today will be at 66.40, followed by 66.85, 67 figure level, which is this congestion area here from the 28th of June to 1st of July, and as well as 22nd of July. And if you do the Fibo retracement of that previous drop from 11th of July all the way down to 5th of August, is the 76.4% Fibo retracement as well. Okay, only a drop with an hourly close below 65.65 will invalidate today's intraday bullish bias to expose the next near-term support level at 65.14, and a break below 65.14 exposes the next minus swing low of 6th of August that is acting as a next support level at 0.6470. Right, let me put it down in writing. Okay, good. Okay, so that's for the Aussie dollar. Now, moving our focus now will be the dollar yen over here. So the dollar yen, like I say, yes, even though we see a bit of movement out on the dollar strength, as shown by the that 5-day this particular chart over here. Okay, this 5-day rolling performance chart where the dollar strength start to see coming back to the yen. But if you look at the closer look from a technical perspective over here, okay, it's just going to trade sideways below the short-term pivotal resistance of 14850 level. Okay, so still no change, still using 14850 level as my short-term pivotal resistance level. Still maintain that short-term intraday bearish bias. First support level to watch will be at 14580. Okay, 145. Only a breakdown below 14580 may expose further potential intraday weakness to expose the next near-term support level at 14420 next. Okay, only an hourly close above 14850, then we will potentially invalidate today's intraday bearish bias to see a much more meaningful rebound phase taking shape back into the dollar yen again for the next near-term resistance zone to come in at 151 figures / 15170, which correspond also the 200-day and the 20-day moving average, I think, as a similar resistance area as well. Okay, so that's for the dollar yen, and that sum up the intraday technical outlook on the FX market. So with that, now let us shift our focus now on the major stock indices, starting with the Asia Pacific benchmark index first, Hong Kong 33, or the Hang Seng index. So still recall yesterday Hang Seng index, we do have a bearish bias below 17,270, looking for it to dip down towards 16,880, 16,720. So 16,880 almost has been met by today's current intraday low level of 16,913, give or take. So with that, and there's these two positive candle right now that has already taken shape over here. These two bounce, very positive intraday candlestick that has been formed. So with this two positive intraday candlestick that is showing up based on its current price action at this juncture, the odds for it to actually shape a further pullback on the intraday basis has reduced. So with that, we'll flip to a bullish bias on the intraday basis right now, using 16,880 as my short-term pivotal support level. A breakout above 17,270, which was managed to get tested an hour ago, exposes the next near-term resistance zone of 17,410 / 17,517 next. Okay, this congestion area here, only a price push down and with an hourly close below 16,880 will continue this short-term intraday downtrend movement to expose the next near-term support level at 16,720, and a breakdown below it exposes the crucial 5th of August and 6th of August key medium-term swing low area at 16,460 next. Okay, so that's for the Hong Kong 33. Next up will be the Japan 225, i.e. the Nikkei 225. So the Nikkei 225 this morning or yesterday, it managed to come down, almost hit our first support level during the US session, the start of the US session. Then thereafter, it squeezed all the way up, and today's Asia Open continued to push up. And right now is forming right exactly at the first resistance that we highlighted yesterday, 36,885, which is also the descending trend line that I drew from the high of 11th of July. and slightly below the 200-day moving average. That was also the 37,480 short-term pivotal resistance that we highlighted yesterday, which is taking into account this former minor swing low of 25th of July and 1st of August. Okay, so still no change, still using 37,480 as my short-term pivotal resistance, maintaining that short-term intraday bearish bias for at least a mean reversion drop to take shape first in first step on the Japan 225. For sure, first support level to watch will be at 35,740, which can't break below yesterday. A breakdown below yesterday, a breakdown below this level, 35,740, then it could potentially trigger a much more deeper intraday slide to expose the next near-term support level at 34,910, 34,645, which is the minor swing low of 9th of August and 9th of August, yeah, 9th of August. And if we do the Fibo retracement of this current push up from the low of 5th of August all the way up to the current intraday high, it corresponds closely to the 38.2% Fibo retracement as well. Okay, only a price push up and an hourly close above 37,480 will invalidate today's intraday bearish bias to see a potential squeeze up or a continuation of this minor uptrending phase to expose the next near-term resistance to watch on the intraday basis will be at 38,430, followed by 39,270 next. All right, so that's for the Japan 225. Now, focusing on one of the major major European stock index will be the German 30 or the German DAX. So yesterday, recall we do have a pivotal resistance level. Price squeeze up now hit at the pivotal resistance level at 17,960, which is the former minor swing low of 14th of July, and slightly below the 20-day moving average at 18,030 level. All right, this level here. So with that, I have a bit of access for today, taking into account of the 20-day moving average that is slightly above it, 17,960/18,030 level. And also, if you do the Fibo retracement of this prior steep fall from 1st of August all the way down to 5th of August, it also kind of correspond to the golden ratio of 61.8% as well. Okay, so as long as this 17,960 upper limit, the excess / 18,030 short-term pivotal resistance is not surpassed to the upside, potentially there could be a first sign of a mean reversion drop first to take shape. So still maintaining that short-term intraday bearish bias on the German DAX or the German 30. First support level to watch on the intraday basis will be at 17,810 level. Okay, let me put it in writing so that you guys could see 17,810 level. Okay, 17,810. Below it, potentially trigger a much deeper intraday mean reversion drop to expose the next near-term support level 17,650/17,530, which correspond to the 200-day moving average acting as a support level as well. Only an hourly push up with a close above 18,030 level will invalidate today's intraday bearish bias to see a squeeze up for the next near-term resistance to come in on the intraday basis to watch 18,140 followed by 18,270 next. Okay, so that's for the German 30. Now moving on will be the major US stock indices, starting with the Dow Jones Industrial Average, i.e. the US Wall Street 30. So yesterday the US Wall Street 30 squeeze up, break above our short-term pivotal resistance level and managed to hit the next resistance at 40,110. So this 40,110, if you do the Fibo retracement, okay, it corresponds to the close to the 61.8% Fibo retracement, okay, very closely to it, this level. So with that, I will flip to a neutrality stance for today on the US Wall Street 30. So neutral between 40,110 and 39,845. So only the price move down below 39,845, then we will kind of validate a short-term intraday bearish bias back again on the US Wall Street 30 to expose the next near-term support level at 39,575, followed by 39,235 next over here. So what we could see over here is that the RSI has started to also exit from this overbought level, okay, at this juncture, okay. But however, if price is going to push up, we got to respect the price action. That means, i.e., this minor uptrending phase is still intact. So a breakout above 40,110 potentially could see a further squeeze up on the US Wall Street 30 for the next near term resistance level to come in at 40,380, followed by 40,790 next on the intraday basis. So that's for the US Wall Street 30. So moving on will be the Nasdaq 100. So Nasdaq 100 yesterday underperformed, all right? So it still remains below our short-term pivotal resistance at this 19,230. So still no change, still using 19,230 as my short-term pivotal resistance to maintain that short-term intraday bearish bias for at least in first step a mean reversion drop on the intraday basis. But I do have a first support level to watch will be yesterday's minor swing low at 18,920. A breakdown below 18,920 will expose 18,680, followed by 18,435 slash 18,310 next. Only a push up for hourly close above 19,230 will invalidate today's intraday bearish bias on the US Nasdaq 100 to see the continuation of this minor uptrend phase to unfold, retesting the 50-day moving average, acting as a resistance level very closely. What is the 50-day moving average? Very closely to the 19,600 level, which is the minor swing high area of 1st of August. All right, a breakout above 19,600 exposes the next near-term resistance level at 19,900 next, which is the 2-time Fibo extension as well, and 2-time Fibo extension from the low of 5th of August, and as well as corresponding to the minor swing high of 23rd of July and 24th of July this year. Okay, so that sum up the intraday technical outlook on the major stock indices. So now let us focus on the commodities market, starting with the gold XAU/USD. So we call that gold XAU/USD since the start of this week. We flipped to a bearish bias. Why? Because it's at the top of this channel, and indeed there was a bearish reaction yesterday. Came down, hit our support level, okay, 2460 and 2435, very close before shipping this bounce off again because of a hourly RSI oversold region. So at this juncture, so with that over here, we'll still maintain that bearish bias given the fact that potentially it could still involve much lower ground towards at least the middle part of this symmetrical triangle, and even retesting the 50-day moving average, which is coming very close to the lower limit of this minor symmetrical triangle depicted in dotted purple line that is in place since the current all-time high of 17th of July. So for today, using a much more tightened key short-term pivotal resistance, we will maintain our short-term intraday bearish bias for gold as it continues to inch down lower towards the lower limit of this potential ongoing minor symmetrical triangle range resistance that is still in play. First support level to watch on the intraday basis, 2,435 for sure. A breakdown below it exposes the 20-day moving average that is also acting as a support level at 2,415. However, a price breakout with an hourly close above 2,460 will negate today's intraday bearish bias to see a retest again on the upper limit of the symmetrical triangle at around 2,470/2,483, which is the current all-time high area. Okay, so that sum up for gold XAU/USD. What's next for West Texas crude oil? So West Texas crude oil yesterday broke down our short-term pivotal support level, which is the 200-day and the 20-day moving average, hitting the next support at 77.35. So it seems to us that reintegration back below the 200-day moving average, and as well as the 20-day moving average, doesn't bode well for short-term intraday bullish bias. So with that, we will flip to a short-term intraday bearish bias again for West Texas crude oil, given the breakdown of its 200-day moving average yesterday. Support level to watch on the intraday basis, 77.35. Below it exposes 76.30 and potentially even 75 figure next. Only hourly close back above 78.46 will negate today's intraday bearish bias to see a retest of this week current intra-week high at 80.30 next, and above it sees 81.20, which is the minor descending trend line that is in place since 5th of July this year. Okay, so that sum up the short-term intraday technical outlook on the major cross asset classes. So before we end today's daily dose of market insights, let's have a quick look at the calendar. What are the key things to look out for? So right before the start of the European session officially at 2 p.m. Singapore time, we have the GDP growth rate preliminary figure for UK out at 2 p.m. Singapore time. Okay, that could potentially impact the movement on the sterling dollar as well. So market is expecting us in terms of the year-on-year growth rate, an improvement to 0.9% year-on-year from previous quarter of 0.3% year-on-year. Then thereafter, throughout the European session, nothing. Then this is where become the all-important retail sales figure at 8:30 p.m. Singapore time over here. So if we go all the way down, the retail sales year-on-year. So if you look at the retail sales year-on-year over here, the trend is not that fantastic. You look at the year-on-year trend, it continues to plateau downwards since 3.6% year-on-year in March. All right. So if today it continues to plateau much drastically below 2%, that could also indicate the risk of that recessionary scenario or hard landing scenario coming back into the US economy back again. Okay, because we know that retail sales represent the retail services sector or the services activity in the US. And we also know that the services activity in the US contribute to close to 3/4 of US economic growth. Okay, something to bear in mind of. So that will be releasing at 8:30 p.m. Singapore time. Then thereafter, we also have another about this. Yeah, this will be rather erratic, but market will still pay close attention to it. Is the jobless claim figure. So continuous jobless claim figure will be out at same time at 8:30 p.m. Singapore time. Okay, something to take a look at. Then thereafter, we do have one Federal Reserve official speaking, Federal Reserve official Musalim speaking at 9:10 p.m. Singapore time. And thereafter, at 1:10 a.m. Singapore time, you have another official speaking, Fed Harker speech. All right, so Friday morning, not much of nothing. Friday morning, there is no key data to look out for. All right, so with that sum up today's daily dose of market insights. Thank you for your time. I'm Kelvin here, and just a public announcement to make. Tomorrow I'll be away, so for tomorrow there'll be no daily dose for tomorrow, I repeat. And also for the entire week of 19th of August all the way up to the 23rd of August, I'll be away on course as well during the day. So there'll be no daily dose from next week, from next Monday onward, 19th of August, all the way up to the 23rd of August. And daily dose will resume on the 26th of August. So with that, I wish you all a great day ahead. Do remember, practice proper risk management, and I shall speak to you soon again on the 26th of August. Thank you.